Moving on to some business news now. The dollar held onto recent gains on Wednesday, supported by higher Treasury yields, as strong US economic data diminished the likelihood of further Federal Reserve interest rate cuts. The greenback rose to a near 6-month peak against the yen after data released on Tuesday showed US job openings unexpectedly increased in November, although hiring softened, suggesting the labour market slowed at a pace that probably does not require the Fed to be in a rush to cut rates. Meanwhile, growth in the services sector accelerated in December, boosting business activity and pushing prices to their highest levels since early 2023. Investors are now focused on Friday's monthly jobs report, one of the last major data releases before the Fed's upcoming monetary policy decision. For more, we're joined by Farah Murad in Dubai. She's a senior market analyst at Equity Group. Good to have you back on TRT World. Farah, now, was this data a surprise for markets? And what does it suggest about the state of the US labour market?
I mean, the reaction shows that it is a surprise. First, we have record increase in price index and services, and we have way better than expected job market. And I can see not only this pressure that we're seeing on indices, but even hedge funds, dealers, they're moving towards hedging with the VIX index. It went up by over 5% yesterday. So yes, it is a surprise. We're moving towards hedging these I wouldn't say unexpected, but at least we were seeing the sequence of less inflation pressure, a little bit of bad data in the labor market, and now we're back again of this fear. What would the Fed do when we have inflation pressure from one side, but also the job market is really doing good somehow, and that's why the markets are a little bit worried and surprised.
Right, and the Fed does have its next monthly meeting coming up where we're expecting a decision. What are markets currently pricing in?
I mean, even before this data, we were pricing that we would keep interest rate steady. There's no change, no maybe a huge change in the policy for now. And I think this is even more emphasized. We believe that there's no way to maybe see cut rates in the upcoming meeting. Now the question would be for the next meeting in March, are we going to see a drop in interest prices? I think we might have been a bit more expecting a bit more dovish stance from the federal bank. I think we might at least for the first quarter see a bit more hawkish stance from the federal bank and keeping interest rate as long as definitely the job market is showing signs of strength and the inflation pressure remains, which I think might be the main scenario, at least the first quarter with Trump in office.
And investors are awaiting that December jobs report, which is out on Friday. What's your outlook?
The forecast now is at least to see a bit of drop around 160K from over 200,000. So in case the numbers comes as expected, maybe the markets will be a bit more balanced. We wouldn't see this huge volatility. But if it comes as a positive surprise, then we might continue seeing the VIX index being a way to hedge against this volatility. We might see a move towards more, I would say, the green, definitely the dollar, the gold. We need to see what Friday will bring. But the most important thing is not only the number of non-farm payrolls, but also unemployment. Is it way above 4% or not? And the wage. That's pretty much the most important numbers in the report on Friday.
Okay, Farah Murad, we will have to leave it there. Thank you very much for joining us.
Thank you for having me.
Now, corporate bankruptcies hit their highest level since the aftermath of the global financial crisis. A staggering 686 companies were forced to close their doors, an 8% jump from the previous year. It was the most since 2010, when 828 businesses folded under similar pressures. The weight of sky-high interest rates and a weakening demand from consumers proved too much for many, sending struggling companies crashing. And as the US prepares for a new chapter under President-elect Donald Trump, the business world is also bracing for a shift. Trump's promises of less regulation, lower corporate taxes, and a more pro-business stance has set the stage for a dramatic change. Dealmakers in particular are hopeful that a friendlier environment for mergers and acquisitions will unfold, with expectations of looser antitrust enforcement, especially with Andrew Ferguson, Trump's pick for the Federal Trade Commission, set to replace Lina Khan. For bankers, 2025 promises to be one of the best years for deal-making in the past decade. Global deal volumes are expected to surpass $4 trillion, the highest in 4 years. The recovery is already underway. M&A activity has surged, with the total value of deals rising 15% from the year before, reaching an impressive $3.45 trillion. This is a significant rebound from the previous year, which had seen the lowest deal volumes in a decade. The US alone saw a 10% jump in deal volume, hitting $1.5 trillion, while Europe and Asia enjoyed increases of 22% and 11% respectively. With the winds of change at their backs, the stage is now set for a banner year in global mergers and acquisitions. For more, let's bring in Swaran Singh, who's in New Delhi. He's a professor of international relations at the Jawaharlal Nehru University. Good to have you on the program with us. Now, 2025 is set to be a promising year for mergers and acquisitions. How much of that is due to Trump's loosening of regulations?
Thank you. As your report showed already, there is already a certain upswing in global mergers and acquisitions, from 3 trillion to 3.45 to this year $4 trillion expected. So there is an overall trend in that direction. Second, yes, definitely, since in geopolitics there is so much bracing happening with the coming of President Donald Trump, the reverse is true of the markets, particularly of mergers, and that is likely to go up. And one can look at the first term of President Donald Trump, and obviously much of the loosening attitude allowed much faster, particularly in energy sector, in services sector. So example of the first term of president is giving hope, and one after another surveys are showing greater enthusiasm and hope among investors, among CEOs of the second term of President Donald Trump, also witnessing a similar kind of loosening of attitude, particularly compared to President Biden's period, when, for example, the Trade Commission and the Antitrust Division of the Department of Commerce, in that sense, was much more stricter, and recently the kind of vetoing that happened in terms of disallowing mergers in steel in that sense. So the greater hope, both in the United States and I think also at the global level of 2025, witnessing much more of mergers and acquisitions.
And as you mentioned, the Biden administration recently blocked the US Steel and Nippon Steel deal. Could we see Donald Trump reverse that decision?
Yes, the bigger canvas makes us feel that maybe there is going to be change of hearts. But on Japan, I think even President Donald Trump has been relatively cautious. And I think one is not 100% sure that the overall imagination of controls, antitrust controls loosening will also apply to particularly this Nippon Steel case, because Donald Trump has shown much more caution on that subject. So that could maybe not be an ideal, we will not be an ideal case to see how President Donald Trump's second term in White House is going to enhance, encourage, and loosen controls on acquisitions and mergers. But of course, the new environment could also perhaps create relatively better atmospherics if that is anyway Nippon Steel is going to continue with that process of mergers and acquisitions.
Okay, Professor Swaran Singh from Jawaharlal Nehru University, thank you very much for your time. Now, a quick look at some of the other top business stories from around the world. Australia's consumer price inflation ticked up from 2.1% to 2.3% in November as electricity costs rose. That's as core inflation fell to 3.2%, bolstering hopes for rate cuts by the Reserve Bank of Australia as early as next month. A probe has opened in the US into 2.6 million Tesla vehicles over reports of crashes involving an app that allows users to move their cars remotely. The National Highway Traffic Safety Administration says that the vehicles failed to detect posts or parked vehicles. It comes after an inquiry last October into Tesla's full self-driving system after 4 collisions were reported. Amazon Web Services is investing $11 billion in Georgia to enhance its AI and cloud computing infrastructure. The investment supports the rising demand for advanced data centers essential for AI-driven innovations. Officials say Georgia is emerging as a key tech hub, attracting investments due to its growing infrastructure and skilled workforce. And Samsung Electronics expects its fourth quarter profits to fall nearly 30% from the previous quarter to $4.5 billion. The company is struggling to meet strong demand for AI server chips, impacting its performance. Samsung, the world's largest memory chip maker, says it's facing a crisis in technological strength. Despite the challenges, its profits are up significantly from the same period last year. Now, rising energy prices across Europe are hitting some countries much harder than others. Those in the southeast are paying the most, with experts warning higher costs will impact economic growth. The war in Ukraine, falling gas reserves and poor infrastructure are all compounding the problem. That's as forecasters predict freezing conditions are on the way. TRT World's Victoria Innes has more.
If you live in southern Europe, you're likely to be paying 5 times more for your electricity than someone living in Scandinavia, and double what someone living in Central and Western Europe is paying. Take Greece, for example. It's been spending billions on energy subsidies to protect customers, 5% of its GDP in 2022 to be exact, the highest in the EU.
Today, electricity costs essentially represent a second rent. Even though rents for restaurants can be very high, which is well known to everyone, in many cases the electricity bill from the provider exceeds the rent itself.
But despite the help, people are still struggling. They're struggling in Romania and Bulgaria too, and in the Balkans. So why is there so much disparity? It's partly down to poor connectivity. The northeast has many more power and gas lines, which make energy transfer easy. They also have more renewables, while the south is isolated, meaning at times of high demand, like heat waves last summer, the grid can become overloaded. Then there's a lack of energy storage, non-existent in parts of the southeast. And of course, the war in Ukraine, which put an end to Russian gas flowing to EU states.
The markets had already factored in the end of the transit agreement, and we have not seen price spikes in the new year. I would also want to add that, yes, with the caveat that we are not a market actor, the Commission as such, we're not selling, we're not buying, but the market fundamentals remain stable.
Brussels says the impact has been minimal, but there has been a knock-on effect. Countries are being pushed to find more expensive alternatives. There is more competition. Plus, they're buying record amounts of liquefied natural gas from Russia instead, meaning they are still exposed to changes in market price. Overall, there just isn't enough gas coming in, which is pushing prices up and causing them to stay there. With experts warning the gap between certain countries will only widen as winter hits.
Our monthly bill is around $160 despite minimal usage, as we're almost always out of the house. We only use the basic appliances, and only from 8 or 9 p.m. onwards.
And at least for this winter, some will continue to bear the brunt of higher costs more than others. Victoria Innes, TRT World.
The European Union faces a paradox in its energy policy. While overall imports of liquefied natural gas has declined, reliance on Russian LNG is growing, even setting new records in 2024. This shift, driven by price preferences and market dynamics, raises questions about the effectiveness of sanctions and the bloc's long-term energy strategy. In 2024, EU imports of Russian liquefied natural gas reached 16.65 million tonnes, the highest since 2017. That's more than the 15.2 million tonnes in 2022 and 15.18 million tonnes in 2023, despite sanctions. Spot market sales rose from 23% in 2023 to 33% in 2024. Russian LNG now accounts for 20% of the EU's imports, up from 15% in 2023, while 20% of Russian LNG is re-exported to third countries. Much remains in Europe. Analysts warn that upcoming EU restrictions could ironically increase LNG imports as spot market sales grow. Total EU LNG imports from around the world dropped by 20% last year, with fewer purchases from the US. Russian gas remains cheaper, making it attractive despite long-term plans to phase out fuels by 2027. The EU's ongoing efforts, including a transshipment ban, leave questions about the future energy security unanswered. For more, let's bring in Merman Margvelashvili. He's the Director of Energy Studies at Ilia State University. He joins us from Tbilisi. Good to have you on the programme with us, Merman. Now, Ukraine recently halted gas transits to Europe. How will this affect the continent's energy prices?
Thanks for having me. The event of gas disruption was not sudden, and the markets were preparing for that. If you look at the spot market prices over 2024, you can see a gradual increase. So what happened now is that in January, at January 1st, we had the peaking of the price at about 50 euros per megawatt, and now it is gradually coming down. Slowly coming down, and these are two factors. One is that the market was expecting shortage of gas, and we have already the effect. Second is this winter is colder than the previous winter, so that compounded into this price. Further down, probably we should expect further decline once the winter goes away. Then the prices probably will be stable or maybe even slightly go down.
And what are the main factors driving the EU's continued reliance on Russian LNG despite sanctions?
Well, first of all, there has not been explicit sanctions on LNG imports. Therefore, this continued reliance is not a surprise. Second, Russian LNG is cheaper than, for instance, American LNG, and last year's prices were relatively low compared to the prices of 2023. So the LNG from Russia was more competitive. One other thing is that you already mentioned that there is a significant transshipment, and Russia uses its icebreaker tankers to come to the major ports in France, in Belgium, and then part of that LNG gets transshipped to other countries. So naturally, a great big share of that LNG remains in France, for instance, which is the biggest importer of Russian LNG. So with transshipment ban, we could expect that factor will drop out of the picture, and that may have effect on reduction of the prices of the import from Russia.
And Merman, do you believe the EU can realistically phase out Russian fuels by 2027?
Well, it depends what you call phasing out completely, because, for instance, it is a complex interconnected structure, the energy market. For instance, China and India are the most beneficiaries of sanctions on the oil, Russian oil. Oil goes to India and comes back to Europe in the form of diesel. So formally, they may achieve such a goal, but I'd rather prefer to see more realistic objective that would be defined in a way of and also related to policy. Another thing is that we are facing very dynamic developments next several years, so it is very tough gamble to really predict what will happen in this way.
All right, Merman Margvelashvili there in Tbilisi for us. Thank you very much for your time.
Thank you.
Now, Donald Trump has raised the possibility of using economic or military force to take Greenland and the Panama Canal. These are topics he has brought up before, but during an hour-long conference on Tuesday, the president-elect seemed to go a little further, drawing a quick response. Craig Boswell reports from Washington.
The leader of the Conservative Party in Canada said, under no circumstance will it ever be the 51st state.
Maybe he won't win.
In a wide-ranging back and forth with reporters, U.S. President-elect Donald Trump would not rule out military or economic coercion to take control of the Panama Canal or force Denmark to sell Greenland to the U.S.
You're talking about Panama and Greenland. No, I can't assure you on either of those two. But I can say this. We need them for economic security. The Panama Canal was built for our military. I'm not going to commit to that now. It might be that you'll have to do something.
Denmark's prime minister said Greenland will decide its future and it's not for sale.
I will make it very clear that, seen with the eyes of the Danish government, Greenland is for the Greenlandic people. It is a proud people, a language and culture that is their own. And as stated before by the chairman of the Greenlandic Parliament, Mute Egde, Greenland is not for sale.
At about the same time, Trump's eldest son, Donald Trump Jr., arrived in the region on what he called a private visit that very publicly heightened speculation about the president-elect's comments. Trump has repeatedly suggested that the U.S. take over the Panama Canal, and he criticized former President Jimmy Carter for the deal that transferred it to Panama. Criticism coming on the same day as Washington begins the state funeral for former President Carter.
The Panama Canal is a disgrace, what took place at the Panama Canal. Jimmy Carter gave it to them for $1. And they were supposed to treat us well. I thought it was a terrible thing to do.
Trump says the U.S. is being overcharged for using the waterway. Panama's leader has rejected all of Trump's comments and says it is also not for sale. He also criticized Canada, saying the country should become a U.S. state due to American spending and military support, which drew this terse and colorful response from Canadian Prime Minister Justin Trudeau. Not a snowball's chance, he says. Hot-button issues on the front burner for the president-elect less than 2 weeks before his inauguration day. Craig Boswell, TRT World, Washington.
Well, that's all your business news for now. Thanks for watching. The Newsmakers is next.